I would love to sort of start on the film.
Okay.
Tell me how where did the idea come from?
Well, Robert Disner in our office was a big fan of Errol Morris and said, I wonder if we could do something together, maybe describe the history of Dimensional or whatever.
Yeah.
And that's kind of how we started. But once he got into it, it really became his film. It started out as being our film that he was going to do for us.
Yeah.
And ended up being his film because he took a personal interest in
Yeah.
it. I mean, the distinction is meaningful, I think.
Yeah.
And you can see from the movie, he's a scholar himself. I think he has a PhD, like in the history of science or something.
Wow.
And and he drew a parallel, to the 16th century in astronomy. It's a really and he's big fan of the art. So when he was walking around the property, I had no idea he would integrate, pictures of the art on the property.
Yeah.
And so from my side, I really realized there's really a skill in filmmaking. I wouldn't have done it. I wouldn't have shot the art. I wouldn't have included some of the quirky people we have in the movie, but I probably wouldn't have included them in it. But I asked him, what was the fascination? He goes, well, you were all just such a quirky group of people.
Yeah.
And I looked at it. Of course, I'm normal. Everybody else is pretty quirky.
Yeah. What do you? I mean, I want to ask about the quirky people, but I'm curious about what do you make of the personal interest? Why did he take such a personal interest in it?
Well, it really is. It connects into the history of science. I mean, there was a revolution in finance in the 60s and 70s. It was made possible because of computers and data. Before 1960. You didn't have enough data, and if you did have data, the computers weren't there big enough to process big data. To do a lot of this research, you have to have the returns on every stock basically in the world every day. Right. So we were dealing with big data back before we used the term big data.
Yeah.
And that was the handicap. Without big data, you couldn't really test a lot of things in finance that you were interested in.
Yeah.
Like, is my manager worth a hoot? I mean, you couldn't test that out before say the early 60s.
And that's another thing I want to come back to is like I want to just describe a little bit of what investing was like pre.
Yeah.
But I don't want to move off. Why do you think Errol had this personal interest?
Because of his background in history of science. So he sees here's a fundamental paradigm shift in the way we think about investing in finance that exploded in the 60s and is still not fully accepted broadly. Yeah. So we have these quirky scientists coming up with this great new science
that nobody really knows about.
That nobody knows about.
Nobody. Yeah.
And part of the reason nobody knows about it is those of us that have studied it have a tendency to want to talk about it using the same language.
Yeah.
Let's call it the geeky language.
Yeah.
And that's not a way to endear the masses. You know?
Yeah, well, I mean, when somebody looks at you sort of sideways, when you're trying to explain risk, and you try to help the situation by saying, standard deviation.
Oh, yeah,
that doesn't really help.
And keep in mind, the markets are heteroscedastic as well.
Yeah. Easy. Just for the listeners real quick, I just want to explain my version of what life was like before.
Okay.
And then I would love to hear your version. So it's hard to imagine. But when I started, and that was in the 90s, right, you had to call me to get a stock quote.
Unbelievable.
I mean, it is really quite crazy to think about. Like, I try to describe this to my 27-year-old daughter who's in finance, who was a guest on the show. And she's just like, you can't describe it. You had to call me. There was no internet. Al Gore hadn't invented it yet. That's I'm glad we got a laugh out of that one, right? So there was no internet. In fact, it was a kind of a revolutionary step when the internet came around and you could get 15-minute delayed quotes. Like before that, you had to stand in front of the brokerage firm with the ticker tape, the little digital ticker tape, or you wait for the newspaper tomorrow or call a brokerage firm.
Well, and you're young. When we started the firm in '81, there was a new machine came out called the Quotron, and that was so cool. We couldn't believe how cool it was. You could actually, if you have
How would you describe that? Like almost like a typewriter with a little screen on the front.
Yeah, it looks just kind of like a laptop computer now, but it was.
But like 10 times bigger. Like a
Well, no.
typewriter,
Well,
right?
it turns out that was what you saw. That's what you operated. It was
Yeah.
like a little typewriter in front
Yeah.
of you. For those that remember what a typewriter is.
Yeah.
But the funny part of that story, funny in quotes, was when we started the firm, we started in my apartment. We didn't have enough money to rent office space out.
Yeah.
So I converted my spare bedroom to our trading room, and we ordered a Quotron machine, and and we had one of the first IBM PCs. I did all our coding early on the IBM PC for all our systems needs. Then so the day comes where to install the Quotron, and that little typewriter, that's fine. That's all I knew.
Yeah.
But it turns out it's connected to something about the size of a refrigerator.
Like a mainframe.
A big CPU, and the decibels on the CPU was about equivalent to a jet engine. So I go, holy cow! I can't sit in the room with that thing. Fortunately it had a sauna, so we ripped out our sauna and made a soundproof
the Quotron in the sauna
room. Put the CPU in the sauna, and then that's how we got started.
So crazy. So in terms of practical implications for investors back then, I mean, I remember when, like, honestly, some of the advice I got when I first got in the industry was like legitimately have a hunch, buy a bunch advice, because there was nothing else. Like the idea of portfolio design, that each individual piece, each individual investment should be evaluated on its own merits, but also very importantly on its contribution to the whole.
Right.
And that you'd be intentional about that. That's it's crazy that was a new idea at one point.
That's right, but that's really part of the revolution.
Yeah.
It's really a revolution about think in terms of portfolios, not individual stocks.
Yeah.
What are the drivers of returns? Why does one portfolio have a higher average return than another? That sort of thing. That's really the focus of the research.
Yeah. So let's back up to the quirky people.
Yeah.
I don't know if we put Gene Fama in the quirky people bunch.
Well, I think I think we would. I mean,
as a term of endearment.
As a term of endearment, yeah. No. We've been lifelong friends. I mean, really for 54, 55 years now.
Yeah.
And we're still really, close friends. And he gets up. For the golfers out there, what he does, he has kind of a bad back.
Yeah.
So he loves playing golf. So he gets the green, and he putts once. He goes, "That's it," and picks up the ball. That gets a little quirky.
That is.
So
a little quirky. Talk about his, what do you think his most important contribution to finance that actually has an application in somebody's life?
Well, it's this notion of market efficiency. That's what he got his Nobel for in 2013.
Yeah.
And basically what it says is, markets work pretty well in terms of sorting through risk and return.
Yeah.
Markets don't appear to be predictable, and people that try to outguess the market, those funds and people that try to outguess the market, their results look pretty random.
Yeah.
That's at first blush, that sounds awful. People that are really smart and work hard can't do better than the market.
It's un-American.
Yeah, it's un-American. Yeah. And the answer is that's why you would. It's really important that that's the conclusion, because that means when companies go to issue capital, in the public markets, they issue stocks or bonds.
Yeah.
Because things get priced fairly, it makes the whole market more efficient. That's the strength of the U.S. capital markets is how well they work. So it's a very powerful idea.
And why is that powerful in an individual? So somebody who knows nothing about finance,
right,
just needs to invest their own money.
Right.
Why is that so powerful to them?
You take Joe or Jane going to just coming home at night, not know anything, not in the financial business, kind of trying to pick a stock. Yeah. Well, the odds of picking a winner for Joe and Jane are the same as for the professional investor. I mean,
Right.
the pros don't seem to be able to do any better than that. I think, or stated different. Sometimes, if you want to be cheeky, we often say, look, suppose you had a large universe of orangutans picking stocks by throwing darts at the
That's right.
Wall Street Journal stock listings.
Yeah.
You know, 1 in 1,000 of these will beat the market every year, 10 years in a row. You know, that's fewer real live managers do that.
Yeah. Yeah. That's
So-
pretty amazing.
I mean, sometimes you say, well, because the orangutans are assumed to work for bananas, and the active managers charge high fees. So anyway,
Yeah.
that's in a nutshell what I mean. And it's really a democratization of investing.
Yeah.
As a result, then, market-like portfolios sprang up. I worked on the first foray into that sort of activity, part of which is indexing, and we'll need to cover that a bit more. I went to work at Wells Fargo in 1971, and they had 2 groups at Wells Fargo working on kind of modern portfolio management. And because what had happened was, by that time, people accepted the idea. It looks like the pros, their results look pretty random.
Yeah.
So what are you supposed to do?
Yeah.
I mean,
Yeah.
well, basically, what you want to have is thousands of stocks in your portfolio, not tens or a handful.
Yeah.
Then the trust department said, well, what we'll do is we'll do an S&P 500 index fund.
Yeah.
That's what we'll do. Our group, which was our 2 main consultants, were Fisher Black and Myron Scholes. They said, no, you can. They drew on a recently developed theory of Bob Merton, this you can call it multi-factor theory. We don't need to get into that, but it says the implication being in theory, you can engineer portfolios to have returns that beat the market.
Yeah.
Probably because you're taking more risk. But so that's an engineering proposition that we worked on. And then while they were working on this kind of indexing or modern thinking, the 2 of them working together developed a Black-Scholes option pricing model while we were working on this indexing. And that's which was based on Fama's. So we have Fama's efficient market, Bob Merton's multi-factor theory, and Black-Scholes coming together all in like a 2 or 3 year window.
Yeah.
I mean, it's the Wild West of finance.
Yeah.
All this, which explains Errol Morris's excitement, because you could how the world really changed for the better.
Yeah.
So for the last 50 years, investment options available to individuals have gotten better and better as fees have come down and better risk controls. All that comes from this group of quirky people trying to apply research in the 60s and 70s. Very cool.
Yeah, it is very cool. And just for the listeners, like, I don't know that you could overstate the collection of people that made that all possible in terms of the impact. Like that, in terms of finance, that's amazing that all those people ended up, in a similar place, talking to similar people,
right?
So that could all happen. It's really powerful.
And of course, we've been closely associated with Fama, Gene Fama, and Bob Merton and Myron Scholes.
Yeah.
Myron just stepped down. He for years was our lead independent director, and then Bob Merton was an independent director of our mutual funds.
Yeah.
See, one of the cool things I think about the firm is the people that are monitoring us through our independent directors of the mutual funds.
Yeah.
They're all leading academics.
Yeah.
And so Myron was a lead independent director. He got his Nobel in '97 along with Bob Merton at the same time. Bob was an independent director. Now he's our resident scientist. And of course, Gene Fama is one of the founders of the firm and has been an independent director of the firm for since the beginning. Yeah. So it's we were a bunch of guys who were young. I mean, actually, I took Fama's course when I was 22 and he was 30. I thought he was an old man.
Yeah, yeah, for sure. For sure.
We were all young together. We're middle-aged together. Now we're getting old together.
Amazing. And one putting.
One putting, yeah.
One putt, just one putt. That's
all
you need.
Yeah, it's a one putt. Yeah.
Yeah.